Welcome to a walkthrough of the top 5 charts of the week weekly email. So this is the free weekly email that we put out from the website, and basically it's a selection of 5 charts from the blog, social media. So it's a good way to keep up with some of the work that we're doing without necessarily having to check the blog every day, but you're welcome to do that. And it's I try to pick out the most interesting charts and also a good mix across the things that we're doing. And I'm putting a bit of comments here and the link there. But the purpose of this video is to actually add a little bit more than what's immediately shown in this email. So we'll get straight onto it. Chart number 1: percentage of IPOs with negative earnings. So this is for America, and this data is from J.R. Ritter. Very interesting data sets. If you Google that name, you'll almost certainly come up with the results. And he's got like just pages and pages and pages of IPO data there. So if IPO markets is something that you're interested in, or if you just wanted to go and have a look at the original data behind this, then definitely go and have a look at that. But the chart is showing that it's moved up to 76%. So for example, if there was 100 IPOs, then 76 of them were companies that had negative earnings, or earnings less than zero. And it's basically the same, well, it's the exact same level as it was in 1999. So, you're looking back at that period there, it's quite different because, it went from around 50% to massive surge like that. Tells you that there's just a change in risk appetites around that time, versus now it's sort of more almost a structural increase in this level. And if you look at the breakdown, the biggest driver was biotech. From memory, that was 97%, and tech is 83%. Basically biotech and straight tech. Obviously those are going to be the kind of companies that are going to be long on the breakthrough, long on the innovation, and short on the commercialization. Some of them, they'll actually need a certain modicum of capital to be able to actually execute on getting their product to market and getting people comfortable with using, getting user uptake and all that rest of it. But the other thing was that all other companies, all other industries was about, I think it was 56%, the exact numbers in that article there. If you can click on the link, we'll just test that. And well, anyway, the all other companies was at 57%. That's what I thought it was, which is a record high. So that's it's actually higher than what it was back in the .com period. So pretty interesting, like just straight interesting chart. But then also, I guess it says a certain thing about the risk appetite that is in the market at the moment for this sort of thing. The final point that I'd add on that chart is that it's not as strictly apples for apples, in that there's a lot more IPO activity going on here than there was around here. I'll probably put up a chart of that later on, but there's actually been quite a sort of almost a structural slowdown in the pace of IPOs, and there's a lot of reasons for that, but we'll leave that one there for now, and we'll pick that up in a future article. Number 2, the equity risk premium. And this one is showing the equity risk premium, rolling equity risk premium for the US in the black line, the UK in the blue line, and for the average across developed markets other than US and UK in the grey line there. So pretty interesting, just from first glance you can see, UK looks like pretty interesting relative value on that lens, with it's about a 500 basis point spread between them. So no prizes for guessing where the most potential is for a tightening of that equity risk premium. The other point to note is where the US is sitting now, so that on this time frame it's below average, just slightly below average, but notably it is still above where it got to at the height of the dot-com and at the peak in 2007, so you might argue that it can have further to go. And it's also now significantly lower than it was at 7% back in March 2009. Pretty good indicator in that respect, actually, signalling the bottom fairly well there. Same thing in 2003, so it is definitely one to keep watching in case, we take this inevitable turn back upwards. But the other thing that can cause a squeezing of the equity risk premium is higher bond yields. So, the driver of this one here coming down is a combination actually of higher valuations for US stock market, and of course we've had this big turnaround in bond yields, which is looking to be what I would say a medium-term upturn in bond yields. So that is that. Just on the equity risk premium in general, it's quite a good valuation indicator, especially for asset allocators, because rather than just looking at absolute levels, by bringing in the bond yield, you're also effectively considering the opportunity cost. And so, this goes to highlight the whole risk-return dynamic across asset classes. Number 3, speaking of the bond market, we've got here speculative futures positioning. So the formula for this indicator is net speculative, it's speculative longs minus speculative shorts divided by open interest. So I like to standardize it against open interest, just because sometimes these sort of things they're going to be growing across time just by virtue of uptake and by virtue of assets under management across key players in this market growing over time. But anyway, by standardizing it, you also have it so fluctuating around pretty, almost standard ranges as well. And the reason why this chart's interesting is because we're starting to see a bit of extreme there on the red line, which is the US 10-year treasuries, and considerable net shorts there. And basically, when you see any indicator like this, especially in positioning or sentiment, get to an extreme, it's definitely one to pay attention to. And oftentimes when you get that kind of shift, that will create the conditions for reversal. So I would say that given that it's looking like fairly crowded short at the moment, the possibility that we get a short squeeze there. All that you need for that to happen is for a couple of prints of economic data to disappoint and at least cast a bit of doubt on the economic strength of the economic recovery, or something from the Fed, which we'll get later this week. And that's a two-way risk actually from the Fed. And that could drive a short-term reversal in bond yields. If I talked about in this article that it's pretty high odds of getting a short-term reversal in bond yields because of how sentiment positioning been moving like this. But my medium-term bias is still to expect higher yields. We're seeing those breakouts in the 10-year bond yields across a number of markets looks intact, and the fundamental drivers behind that, I don't see those changing, certainly not yet. But something to be mindful of. And number 4, stock market seasonality statistics. See, she sails down by the seashore. It's a bit of alliteration thrown in there for a good measure. So this is showing the monthly return statistics from that period, 1964 to 2017, and pretty much it's a pretty good table because it shows you a bit more detail behind it, because oftentimes for seasonality all you get to see is the average return. And for the average return, April is the best month. If you look at the percentage of the time that it was positive, so this is so if there was 100 observations here would be that 72% or 72 of those times the market went up, and 72% is actually kind of, it's starting to become quite material. 56, 48, those are basically 50-50. But that's but again, I guess the other point to make on that is that 28% of the time it was negative, so it doesn't always work. The other point I would note is that if you look at the best and the worst, or so this is the best performing, or the best performance in April across that time was 9%, and the worst was -9. So go again, seasonality can stop working, especially when you need it the most, and that's why you should always think about seasonality as a supplementary factor, not a core factor. And on that note, if you're looking at April versus December, December has a slightly lower average return, but then it's had higher best and lower worst, or higher worst, and lower standard deviation, so lower variation around that. And that's pretty much it. I guess the other thing to note is that after April, all these months tend to have this sort of red and yellows, which means that that period's generally worse, the whole sell in May thing. And on the topic of seasonality, looking at our last chart for this session is the Bitcoin price seasonality. Now, first thing to note is you look at this chart for the S&P 500 seasonality, we're looking at the period 1964 to 2017, long time. For Bitcoin, we're looking at the period 2012 to 2017, very short time. And then I've had to, I've run it again without 2013 and 2017, because those, as you can see there, just looking at the two, both 2012 and both 2013 and 2017 had this massive surge in the later stage of the year. But interesting to note though, that you still get this upward bias in the last quarter of the year, even if you strip out those two extreme examples. But I guess the interesting point in the the X13 and X17 chart is that in contrast to the stock market, Bitcoin price has this seasonal tendency across that very short time frame to fall, and then it almost looks like a buy in May kind of situation. This is interesting, and again, very limited by the short period of data, but and by the way, that's from an article where I've looked at 5 different indicators for Bitcoin, and that's one thing that market suffers from, is that it's a very short time frame and very limited amount of real factual data, fact-based quantitative metrics. Plenty of people doing technicals on it, and that has its place, but not so much in the traditional financial market analysis space, and that's big reason for that is just due to its nascency. But yeah, if you're interested in that, in the crypto Bitcoin, then check out that article. And that's it. So it's interesting 5 very different charts there across a few different things. If you want to sign up to receive this weekly email report in your inbox, you can click that link there. I'll put the link in the description of the YouTube video, or otherwise you can just go to topdowncharts.com. And only other thing is, yes, subscribe to the channel so that you do not miss out on any future updates.